Navigating the commodity seas. The impact of geopolitical events on prices and trends. In the intricate world of commodities, where supply and demand dance in a delicate balance, the role of geopolitical events looms large, casting a profound shadow over prices and trends. Understanding how global political dynamics influence the ebb and flow of commodity markets is crucial for investors and analysts seeking to navigate the often turbulent waters of this complex landscape. Geopolitical tensions as market catalysts. Geopolitical events, ranging from conflicts and diplomatic disputes to trade tensions and sanctions, have a remarkable capacity to roil commodity markets. Take, for instance, the impact of political unrest in oil-producing regions. A sudden escalation in geopolitical tensions can disrupt oil supplies, leading to fears of shortages and driving oil prices higher. Conversely, resolutions to conflicts or diplomatic breakthroughs may alleviate supply concerns, exerting downward pressure on prices. The Strait of Hormuz, a vital maritime passage for oil transportation, serves as a vivid example. Any geopolitical event threatening the stability of this strategic route can send shockwaves through the oil market, influencing prices not only for oil but also for related commodities and sectors. Supply chain disruptions in commodities. Geopolitical events can disrupt the intricate web of global supply chains, affecting the production and distribution of commodities. Trade disputes, tariffs, or embargoes can impede the free flow of goods, leading to supply shortages or surpluses. For instance, the US-China trade tensions witnessed in recent years had a cascading effect on various commodities, impacting everything from agricultural products to industrial metals. Consider the soybean market, where tariffs and trade negotiations between the United States and China had a direct impact. Shifts in geopolitical relations altered the demand for soybeans, influencing prices and creating ripple effects across related markets, such as animal feed and cooking oils. Currency movements and commodity pricing. Geopolitical events can also influence currency movements, adding another layer of complexity to commodity pricing. When geopolitical tensions rise, investors may seek refuge in safe haven currencies, affecting the exchange rates of major currencies. Fluctuations in currency values, in turn, impact the competitiveness of commodities traded on global markets. For example, a geopolitical event that strengthens the US dollar can make commodities priced in dollars more expensive for buyers in other currencies. This, in essence, can impact demand and contribute to price fluctuations. Conversely, a weakening dollar due to geopolitical developments might make commodities more attractive to buyers, potentially boosting prices. Energy markets and political unrest. Energy markets, particularly those associated with oil and natural gas, are highly sensitive to geopolitical events. The oil market, in particular, is often a focal point for geopolitical analysis due to its strategic importance and widespread impact on various sectors. Instances of political instability in major oil-producing regions, such as the Middle East, can lead to supply disruptions, impacting oil prices globally. The Arab Spring, for instance, brought political upheaval to several oil-producing countries, affecting oil production and contributing to price volatility. Investors and energy analysts closely monitor geopolitical developments in regions with significant oil reserves, recognizing their potential to reshape the energy landscape and influence investment strategies. Commodities as political instruments. Geopolitical events are not only external forces shaping commodity markets. commodities themselves can become instruments of political leverage. Nations may use their control over key resources as a tool in diplomatic negotiations or employ trade restrictions to exert influence. The imposition of sanctions on a country can disrupt its ability to participate in global commodity markets, affecting both domestic and international prices. An illustrative case is the use of sanctions on Iran. Restrictions on Iranian oil exports, driven by geopolitical considerations, influenced global oil markets by reducing the overall supply. This exemplifies how geopolitical decisions can have far-reaching consequences on the availability and pricing of essential commodities. The role of speculation amid geopolitical uncertainty. Geopolitical events introduce an element of uncertainty that can trigger speculative activity in commodity markets. Traders, seeking to capitalize on anticipated price movements resulting from geopolitical developments, may engage in buying or selling positions. This speculative activity can amplify price swings and contribute to short-term market volatility. For instance, if geopolitical tensions escalate in a region known for its agricultural exports, speculators may anticipate supply disruptions and engage in futures contracts related to key commodities like wheat or corn. These speculative activities, while providing liquidity to the market, can also exacerbate price fluctuations, adding an additional layer of complexity for market participants. Conclusion. In the intricate tapestry of commodity markets, geopolitical events stand as both architects and disruptors, shaping prices and trends with a forceful hand. Investors and analysts navigating this landscape must remain vigilant, recognizing the far-reaching impact of political dynamics on the delicate equilibrium of supply and demand. From oil-producing regions to global trade routes, the interconnectedness of geopolitical events and commodity markets underscores the need for a nuanced and comprehensive understanding. The role of geopolitical events in shaping commodity prices is not a mere footnote but a pivotal chapter in the story of global markets, where the currents of politics and economics converge in a constant dance of influence and consequence.